Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe. Click the bell so that you get a notification of when we're releasing a new video. I'm sitting again today with Michael Porter. Hello, Michael.
Morning, Robin.
So, Michael, I was kind of reflecting. We were doing some updates on investments in our investment meeting this week, and I was reflecting. It's been 5 years since kind of COVID. And the big casualty in COVID was one of our key asset classes, which is property. And I think everyone thought, well, it's the end of property, it's the end of the world. Work from home is the whole new thing. And I think we kind of positioned with a lot of clients and said, hang in there, fundamentals for property don't look good now, but it's not the end of property. And those that have hung in have been rewarded, haven't they?
Yeah, Robin. Yeah, I mean, if you just cast your mind back, sorry, let's cast the right thing back. 7 years. I mean, in the start of at the end of 2017, we had Steinhoff,
Yes.
right? Mm-hmm. The whole market was jittery. Mm-hmm. And then in the beginning of 2018, that same crowd who did the report on Steinhoff.
Yes, Viceroy.
Viceroy, that's right. Sorry, my memory's slipping there. But then they released a report on NEPI, and then one or two of the local other, obviously, asset managers, hedge funds and things, got involved with the resilience table. So that was sort of the start of property's demise. I mean, and the de-rating. And I think the SAPI index probably went, probably peaked at 700 or 720 or something by the time COVID hit, which was sort of 2 years later. So we already had a pretty weak 2018, 2019. The sector was struggling, sentiment was deteriorating. And then COVID hit and the index went to 200, from probably peaked at 700 or 720 or something like that. Yeah. So you can just see the extent of the downfall. And yes, I mean, COVID was a perfect storm. Obviously, people not going out, people not paying rents, and then in the aftermath of COVID, work from home and the office is dead and we'll never ever go back to the office again. That hasn't quite played out.
Yeah.
We're all back at the office. But Robin, and then I think just coming out of COVID, and 2021 was a reasonable year. There was a bit of recovery, but then you had the surge in inflation and probably the most rapid increase in interest rates in living memory. I mean, we talked about it often at the time, but globally there was this massive hike in the interest rates, and even locally, obviously rates were cut in COVID, but then you had this surge in interest rates. And if you have a lot of debt, property companies are leveraged, they have a lot of mortgage debt, then obviously with interest rates going up, they were just on the back foot again, and you were just struggling. Your interest payments just ballooned. So property really went through a perfect storm from every angle. It really did. But despite that, it's amazing. I mean, 2021 was a reasonable year for property, and I think there was just really a recovery off the very lows of COVID. And as the vaccines were kind of starting to get rolled out and people were getting back to normal, there was some lights at the end of the tunnel. 2022 wasn't a good year. Actually, property only just squeaked a positive return, 1%. And 2023 was looking pretty mediocre until the last quarter of 2023, and that's really when the sentiment really started to change. So that was probably when load shedding started to abate a little bit. I think the first half of 2023, if we cast our minds back, was dark.
Yeah, dark.
But and rates started to. I think there was an expectation that rates were rolling over, and that last sort of quarter of 2023 was really strong. 24 was very strong. 25 was very strong. The index basically touched 500. That's on a price basis, not a total return basis. But over the last, since the start of 2020, Robin, so including COVID, you've had a 11% total return from property over the last 5 years. So that includes all the COVID drawdown. So the last 2 years have been sort of 30% plus returns. And the sector's back. So despite all the travails that they do, I mean, I think what the one thing we do say, Robin, is we invest in management teams, and management teams are there to make decisions, to empower, to change their portfolios, to do what is necessary. And there's been a lot of cleanup. Portfolios have changed. There's been a lot of rationalization. debt has been cleaned up, and now that interest rates are falling and the economy is on a slightly firmer footing, load shedding has abated. All those solar projects are paying for themselves, and there were some very tough times. Management took action. They've invested in their properties and infrastructure and things, and now that investment is reaping the rewards. And property, I mean, it has re-rated a lot, but it's got further to go if we think that we're going to start getting some GDP growth and rentals will start really growing again. We haven't really had a lot of rental growth for quite a long time. So up until now, I suppose you've had the reduction in vacancies that's giving a little bit of benefit, and you've had the reduction in interest rates. But if we have some now positive rental growth, some positive reversions on top of the other two factors which are still occurring, then you will see good solid distribution growth of 6, 7, 8%, which is inflation beating. That's all you want from property. You're not going to regret investing in property if you're getting those kinds of growth rates. Yeah.
So, Michael, I mean, the three things that we probably really look at in the property space is one, what we call it LTV, the loan to value, how much debt it's got relative to its value. We look at vacancies, how much of its whole book is empty, and reversions, what's happening with the leases that are being renewed. And those are all showing pretty good signs, aren't they?
Yeah, Robin, there's no doubt that companies have cleaned up their balance sheets. There's less debt, there's more security. The sort of, I suppose, the flip side of the LTV is the ICR, which is the interest cover ratio, which really is how much times does your EBITDA cover your interest payments? And obviously the higher the better. And the banks generally insist on 2 times as a minimum covenant when they're issuing debt. But some of the companies were pretty close to that. Some of them fell below 2. I would think on average the sector's now 3 and a bit. On average, so that's improved a lot. Vacancies still have to come down, Robin. Yes, and reversions when your lease expires and you renew the lease. Are you renewing it at a higher rent, a similar rent, or a lower rent? And yes, they've definitely firmed up, Robin. I mean, I think there's still a little bit of room to go. There's still some areas where markets are a bit weak, and even in Joburg, it can depend whether you're in Sandton or Rosebank or wherever the case is. But there's definitely scope for reversions to come through. And I suppose the positive on the property side, Robin, is that there's been very little speculative building for probably 7 or 8 years now. I mean, there's a little bit of building, but quite a lot of the office vacancies are getting mopped up with conversions to residential and things like that. But there hasn't really been a lot of new speculation. I mean, there's a bit in Cape Town, there's a new bit of building, but Cape Town is a buoyant market. But that also feeds through because actually the old stock does get used up, and then gradually the new cycle will start again. Okay. So I think it's exciting on the property, Robin, and I think if you just look at we're talking about our unit trust, the property fund. What's really pleasing is that the property fund is now delivering it delivered the record high income last year to investors, the highest distribution in its history, even higher than 2018, 2019. Yeah. And the distributions that we have given out of our fund have far exceeded what the SAPI index did or what the Satrix property as a proxy for the market did. So our focus on not just the capital return, but also on generating as much income as we can, and that balance really has come through, which is fantastic. Yeah.
Awesome. Well, it's sometimes really nice to look back. Michael, thanks for giving us that amazing detail. Thank you for joining us. Don't forget to like and subscribe, and we'll catch you next time. Bye-bye.